David, while we have you, I got to ask you about a couple big headlines. The first, of course, is Archegos just this morning, Credit Suisse saying that they're going to take a write-down of $4.7 billion. You saw the head of risk and the head of their investment bank effectively lose their job over this. Goldman Sachs, it appears, has gotten out of this unscathed. But what is the lesson? What did you learn from all of this?
Well, Andrew, I think this is a classic case of an investor with concentrated positions that have leverage against them. And when a price moves against that party, it's important to take down risk. And I know, as well as we know, this is not the first time this has happened, and it's certainly not going to be the last. We'll certainly see this again. From my perspective, our risk controls worked well. We identified risk early on. We took prompt corrective action to lower our risk according to the contract that we had with the client. And I can't really speak to what other banks have done and how they've handled the situation, but I'm very pleased with the way our team handled it. There's a larger question here around process by which investors create transparency around their economic positions and how to handle more complex equity products in our system. And I think that's a topic that deserves debate. I think it should be reviewed, by the SEC, and I certainly expect Chair Gensler, as he comes in, to take a view on that, and I think there'll be more discussion on that. But from a broad perspective, what happened here is something we've seen before, something we'll see again. And that's why risk management systems and organizations like ours are very, very important. And we spend a lot of time really thinking about that. We don't always get it right, but this was an example of a place where we did.
Hey, David, I just want to go back to one thing you said, because I think it's important about the Archegos situation, but some of the disclosure things. What do you think has to happen there in terms of the idea that somebody could have these total return swaps and the market wouldn't necessarily know it in terms of how much ownership they really had? What would you do?
Well, I think there's a reasonable debate around the transparency around derivative products. It's one, Andrew, that has been going on for more than a decade, certainly coming out of the financial crisis. I think when we look at the concentration of some of these positions, it's reasonable to have a debate about whether or not there should be more transparency in equity markets around some of these complex equity products. And I think we're going to see that debate, and there potentially could be some movement in the way transparency works around that market structure.
Was it a mistake to be in business with Bill Wong, given the history, the insider trading, and just the risk that he was involved in altogether?
I, Andrew, don't think, going back and second-guessing decisions like that at this point is the answer to this. We look at the way we onboard clients. We go through a rigorous process. The fact that someone had concentrated positions and they were over-levered and therefore there was money loss, that's part of the way the system works. I think the debate around transparency is important. And I think with more transparency, that might help as we go forward. Right. But I think that's a forward discussion. Where do we go from here? I think that's the right way to think about it.
Shepard Smith here. Thanks for watching CNBC on YouTube.